Well, good afternoon, everybody. My name is Lee Schwartz, and I'm the Director of Business Development for SVA Certified Public Accountants. I'd like to welcome you to the third webinar in our Vet Buy Sell series. This one's titled Developing Your Strategy. And before we get started, I just want to take a sec and say a few words about SVA and our history with vet practices. Like many of you, we got to where we are by being independent, and our vision moving forward is to remain that way and continue serving the same clients we have since 1974. And a huge part of that client base over these last now almost 50 years has been within our healthcare practice, which includes medical, dental, and of course, vet practices. Our mindset is that when you're a practice owner or a shareholder, you have to work with someone who's more than just an accountant or tax preparer. You need someone who's a true advisor working collaboratively with you. This webinar and others like it are just a couple of small ways in which we do that. We've got a lot of content to go over today. Only have 30 minutes to do it, but we're going to try to leave a couple minutes at the end for Q&A. Although I always say that, and that's not always the case. So we'll see how it goes. Please send in questions you may have as we go, but we are going to save them till the end. So let me briefly introduce our speakers. We've got two of the most experienced people in our healthcare and veterinary practice to walk you through everything today. We have Andy Slinger, who's a principal, and Joel Recklich, who's a manager. Both of these gentlemen are CPAs, and they work with practice owners and practice managers on efficiency, tax strategy, profitability, and of course, buy-sell strategies. So without further ado, I am going to kick it off to Andy, who can take it from here.
Thank you, Lee, and thank you everybody for joining us today. Before we dive in, I just want to back up a second and remind us all where we are in our series, okay? Right now, where we are in the series is you have a value, okay? You've been presented a report of what your practice is worth, or conversely, you're entertaining making an offer and you have an idea what the buyer wants for that practice. By the end of today, you should be ready to take offers, evaluate offers, or make an offer. That's what we're filling today. That's the education piece we're providing. So in short, what does that valuation mean to you? And is it what you expected? Is it now really the right time to sell? Or if it's not, what comes next? Joel will take us a deeper dive into the tax impacts of that potential sale or purchase. Then I'll come back and talk to you about, is this going to be a private sale or a corporate sale? What are the pros and cons of each? And then we'll wrap up by, okay, yeah, I have an idea now. How do I let potential buyers, sellers know that I'm ready to make a move? All right, so let's get started. As always, we like to have kind of the pulse of our audience. So we want to start with a poll question. So very simply put, you're looking to buy a practice in the next 1 to 3 years. You're looking to sell a practice in the next 1 to 3 years. You're a seller, but I'm really not sure when, or I'm a buyer, but I'm really not sure when. Few seconds, we'll see the results. Drum roll. Okay. Mixed results. So we have basically 1/3 of you are looking to buy a practice in the next 1 to 3 years, and then the other 2/3 are sellers. And half of you are pretty close to ready. Your time horizon's at next 1 to 3 years, and then the rest of you, you're going to sell at some point, but you're just not sure when. So that's great. That gives us a great idea of kind of how to tailor our presentation a bit today. So to get started, again, you have a number, you have a report, and it can be a significantly long report depending on who's doing that valuation of your practice. A lot of due diligence went into that report, and so you should get a very good quality product. Biggest takeaway from the first bullet point is it's not just a number. Okay, it's very important. You invested in that report. You invested in the talent that put that report together. Please make sure that there's a meeting or a set of meetings that go on with that analyst to discuss that valuation. Is it what you expected? Is it high? Find out why. It can't hurt, right? It puts you in a position of strength. If it's not what you expected, well, find out why. What's the low-hanging fruit, or what's the deeper dive you're going to have to do in the near and potentially longer term to get a better number that you're ready to present, and then negotiate from a position of strength. You know your practice. You went into this knowing your strengths and you know your weaknesses. So again, how does what you find out compare? Quite frankly, a lot of times this process simply validates what you already know. Okay, and you're reaching out for that expertise. Behind the scenes, what are and what have been the trends in your practice? Do you have consistently growing revenue the last 3 to 5 years? Or, have you had a gap in your associate pool of DVM talent? Have you had a gap in staffing? Have you recently added new procedures? Have you recently gotten your fees to fair market value? Again, what's the story, so that if I don't see a nice steady climb as a potential buyer, or as what does that tell me? What other barriers to success have you experienced? So again, you can be ready for that narrative. You can be ready for due diligence. You can be ready to negotiate from that position of strength, which is why you went into this. Okay. So let's say now that you didn't get the number you were hoping for, or it's simply validated that, hey, my practice isn't quite there yet. What are the adjustments that you can make? This is by no means an exhaustive list. This is just, again, as Lee mentioned in the presentation that we have, what's the low-hanging fruit? First and foremost, almost to a T, when I challenge a veterinarian on their fee schedule, they admit, probably not charging what I should. And we get a myriad of reasons for that, okay? Only you know where your fees are at, especially in the last 6 to 9 months and going into 2023. This is the time where it's very important to get your fees in line. Normally, we talk about it from a practice management and profitability standpoint. Now we're talking about it from a valuation standpoint. Recently, I sat in one of these meetings with our analysts and the veterinary practice to discuss the results of their valuation. Don't quote me on this, but in simplified terms, they admitted their fees were low. And the analyst said, hey, if you were to do a 5% increase to simply get your fees in line, okay, not to be greedy or overcharge the market, but just to get them in line, potentially the return is hundreds of thousands of dollars in a valuation in the future. Okay, so that got their attention. I think that'll get your attention. There's a reason to keep your fees in line with the market based on the value that you're providing. Is it time to expand your service offering? Is there something that if I offered this, I'd probably get more revenue, I'd probably be more profitable. Maybe now's the time. What's your timeline been and what's it going to be now? Do you have to extend it? Or what? This validated that I've got a really good opportunity here and it's time to make the move. You could be adjusting that timeline back or accelerating it forward, or you're right where you need to be. Do you know you're at capacity? And you know that if I do a remodel or an expansion, that I could potentially, again, bring in more revenue. I could potentially make my practice more attractive. I'm playing the long game at this point, so now it's time to do it. Obviously, we're going to talk about interest rates here in a minute, but a lot of you are flush with cash, so you might be able to hedge that. Easy for me to say, but can you tweak your staffing? Obviously, the most challenging employee market we've seen probably in our careers, but again, do you have the right people in the right seat? Or again, is there some opportunity to, put your practice in a better position by modifying what goes on in your practice from a staffing perspective? And again, outside the valuation is your real estate, because as I told you in 1 or 2, that's done separately by a certified, commercial real estate appraiser. But what was that advice? Is it time to improve the curb appeal on the outside? If I walk into your practice, are there modifications I can make that improve the perception of that waiting room, of the exam rooms, of the employee break area? Are there ways that, again, long-term or nearer term, I can improve the value of that practice or the perception of what I want for that practice? Okay, there's also opportunities to invest in technology. These all tie directly to technology. If I invest in that piece of equipment or those multiple pieces of equipment, does that enhance the patient experience? Does that lead to more revenue? Okay. Does that lead to greater efficiency in my practice, which again, in turn can lead to greater revenue? Same thing with tech utilization. Some of the most profitable practices that we work with and see utilize their techs. Now, it might mean we have uncertified techs, we got to get them some education or certification in certain procedures, or it's just their credential in the first place. That might be an investment that's worth making if we're looking at a longer term horizon to improve the top line and ultimately the value of this practice. Other opportunities for you. Okay. We talk about this all the time, and trust me, it's not just because we're accountants. Okay. But you're going to be showing multiple people your financial statements. You're going to be opening your books. And as I say, it's like you're inviting someone over to your house. You're going to clean, right? You're going to clean up. You're going to get things in order. Get your financial books in order. Okay. If I look at your financial statement, can I clearly delineate your top line, your overhead, your associate compensation, and your owner compensation? Is it formatted that way? If your QuickBooks isn't that way, well, at least you have someone putting it in a summary that's easy for potential people that are going to look at your practice to understand easily. Overhead control. When you did the valuation, the analyst right-sized your overhead, right? And came up with a number. That's the ideal. That's what the potential future owner is going to practice like. At the same time, if I then turn around and look at your financial statements and they tell me a complete different story, I get a little bit leery. I'm like, can I really operate that practice as efficiently as they think I can? Or is the reality of the last 3 to 5 years going to be what is always going to be a barrier I face? So again, maybe it's time to rein in your overhead. How do you benchmark against other practices? Why do other practices do it better? What can I do? Same thing with a balance sheet. If I look at a balance sheet right now and a veterinary practice isn't flush with cash, I'm wondering why. If I look at a balance sheet right now and I see equity is tight or negative, again, it just gives me pause regardless of what the valuation might say. So bottom line, let's get your financial statements in order. Okay, so now it's timeline. Okay, those are the adjustments, but of those adjustments, what effect? What's the low hanging fruit, depending on what we're looking at? 1 year, 3 year, 5 year, you got to pick. What's the easiest? Go in that order, okay? Depends on your short and long-term goals. Right now at that valuation point, whatever your next chapter is, whether it's working part-time, whether it's completely changing careers, moving into retirement, can you live the lifestyle you desire? Or are you going to need a higher valuation? Get ready for due diligence. And due diligence, I'm going to mention at least 4 times. It means they're going to see everything in your practice. Now, a lot of it you already had to show for the valuation if you had one done, but all your financials, all your legal, all your records, your production, everything that goes into your practice, along with in person. What's your equipment look like? What does your facility look like? That's due diligence. They will want to know everything about your practice, as they should if you're looking to buy or if you're looking to be bought. Last but not least, get that lease in order. Even if you just rent to yourself, you own the real estate. Well, I'm going to come in and buy you. I should pay you the rent, right? That you're paying yourself. You should be paying yourself fair market value rent. Why would all of a sudden that rent go way up? You know, what does that tell me? So look at that lease. It should be in good order, because if I'm buying your practice, I want a place to practice. More things to get in order. Do you have buy-sell agreements? If you're taking on an associate, maybe you're not selling the entire practice. Is there a buy-sell agreement? In short, the buy-sell agreement tells me how a veterinarian enters a practice based on a certain valuation. Also tells me at some point in the future, how does a veterinarian exit the practice? Have you assembled your team of experts? Now, you may not eat all of these, but you know if you have a good one, or you know what, I better find a better one. Do you need a broker? How's your accountant? Consultant? How's my attorney? Do I need a banker at the call? Again, much easier to find those people and evaluate them with time versus doing it at the last minute under duress. So do you have your people ready to help you through this that you're probably only going to do once in your career? Right before this presentation, some of our team got together. We were going over tax planning for a practice that just sold, within the last couple of months, and we're going to present that to them on Tuesday. So this is very fresh in my mind. very important to consider the tax effect of this. So Joel is going to take us into a deeper dive on some tax items to consider.
Thanks, Andy. So we're looking at the tax impact from both the buyer and the seller side. From the buyer side, we have the inventory, supplies, accounts receivable, and equipment. Some of these items are available for immediate write-off. The equipment could also be depreciated for 5 to 7 years. Then you have the goodwill, which would be amortized over 15 years. From the seller side, we have the same inventory, supplies, AR, equipment, but when selling it, these items are taxed at your ordinary income rate. And then we also have the goodwill, and that is taxed at the long-term capital gains rate, which is 15%. There is a 20% tax rate that does apply to those individuals exceeding $460,000 or joint filers at $517,000. Next, we'll talk about Form 8594. This is an asset acquisition statement that needs to be filed to the IRS by the seller and the buyer. This puts the purchase price into different classes like cash, inventory, equipment, goodwill. The main thing we need here is the buyer and the seller need to agree upon this. They both have to report the exact same amounts on the form. If there is any differences, you will get an IRS tax notice. Next, we have the real estate effect. Does your practice cash flow? I mean, you could look at feasibly keeping the real estate instead of selling it to the new owner. You know, each year we're paying down that principal. Each year we're hoping that the value of the property goes up, and it could be great to have this piece to go into your retirement for you. Another thing you could consider is a land contract or a seller financing. So if the buyer may not be able to obtain financing through a bank or does not like the high interest rate that is currently available, you could feasibly look at doing an installment sale, 5, 7, 10 years to the seller and get some nice consistent income each year, while also kind of deferring the gain on that building over that course of 5 to 10 years. Something we see less likely is a like-kind exchange. If you sell the practice, you have an opportunity to buy a similar practice within the IRS timeline. As long as you find that new piece of property that you want and buy it timely, that gain that you have from your current building gets deferred into this new building. So we want to make sure your future options are clearly spelled out. Keep in mind, it's not just the sales price. Consider the allocation and payment terms. Next, we'll talk about the effects of higher interest rates. Lower practice valuations because of these higher interest rates. We're seeing more challenges to obtain and afford financing for buyers, which gives opportunity for seller financing, which does come at a risk, but you can have potential higher practice valuation. You can get a lower interest rate to your buyer. So right now you're seeing maybe up to 7%. You could guarantee the buyer 5 or 6%. And then from your point of view, you're getting this guaranteed rate of return at 5 or 6% over the next 5 to 10 years. Now, we want to not consider doing the tax planning too early. So you're going to want to consult with your advisor. First, we just wanted to spell out the net investment tax. It's the newer tax, is 3.8%. That is for passive activities. This does not apply to you. We just want to make sure you are aware that you should not have this tax on your tax return when you sell your practice. Secondly, protective estimates. The easiest way to do this is look at what you had on your prior year tax return. In order to be protective in the current year, you need to pay in at least 110%. As long as you pay in that 110%, any balance that you have on your return, you can pay in April, and there would be no underpayment interest penalties. Now, before I talk about the next two items, I kind of want to give you a little update on Schedule A on your individual tax return. You have the option to take an itemized deductions which consists of state taxes, which is limited to that $10,000. This consists of your real estate taxes and the individual taxes you have on your tax return. Next, you have mortgage interest. And then lastly, you have charitable contributions. So the total of these three items need to exceed your standard deduction in order to take the itemized deduction instead of standard deduction. Now, for single filers, that standard deduction is just under $13,000. For joint filers, the standard deduction is just under $26,000. So now jumping back, looking at the Wisconsin pass-through entity tax election. This allows you to pay the taxes due at a corporate level rather than your individual level. So if you have a practice that will have income of $250,000, you could make a $20,000 estimate at the corporate level, which is fully deductible federally. The great thing about this is if you're selling your practice and you're in a higher tax bracket, let's just say you're in the 35% tax bracket, you could save up to $7,000 by making this election. The great thing about this election is it's an annual election. So you could make it this year and then not make it in future years. Next, we have that donor advised fund, which relates directly to charitable contributions. The advantage of this is you could put a nice lump sum into this donor advised fund, and then you have the ability to give it to your charity of your choices over the course of a few years. The advantage is, now when I go back to that itemized and standard deduction, is that the money that you put in is fully deductible in that year. So then this will allow your itemized deductions to far exceed your standard deduction in that year. And most of our clients have been taking that standard deduction due to their state taxes being limited. So then in future years, instead of having the itemized deduction, you can go ahead and take advantage of that standard deduction. And now we want to look at the timing of the sale. Are you looking to sell before year end, or could you feasibly wait until January 2nd? So if you're looking at selling before year end, the taxes are due in April of this coming year. If you wait till January 2nd, those same taxes are not due until April of 2024. Remember, you want to maximize any available pre-tax retirement plan contributions. So if you have a simple plan, you want to make sure you're maximizing that. If you have a 401k plan, make sure you're maximizing that. If you happen to have a profit sharing component to your 401k plan, you could put money into there to benefit, not only benefit you, but also benefit your employees. Now, Andy will discuss selling practices, private or corporate.
Thank you, Joel. And I'll simply reiterate that definitely was a wonderful presentation, but not an exhaustive list. Those are just the things that I'd say we most commonly help to move the needle on that tax consequence. But obviously there's a lot more we could go into on the tax side. Okay, 3 down, 2 to go. Choosing a private or corporate sale, big choice. I mean, this is one that keeps veterinarians up at night, okay? So first of all, what are the facts? You know, are you selling or buying 100% of the entity, or are we expanding the ownership group by bringing on associates, you know, partially? That's a consideration. What's your geographic location? Some yeah, where I am, based on what's gone on around me, based on what I've heard, this is probably going to be a corporate or private equity sale. What's the size of your practice? You know, again, not one size fits all, but I hear and I see that solo practices, one owner, $1 million or less of revenue, not as attractive to corporate private equity buyers. Okay. So again, does that lead you to what are your options? I'm going to talk about a broker in a minute. That might be a situation where you're going to need a broker to help you potentially find some more buyers. What's your preference? What's your ideal? Please start there. You know, unless the timeline's short or there's some duress, this is your golden goose. This is your baby. Start with your ideal. Do you prefer to sell and keep this a locally owned practice and maintain its culture? What do you want it to look like 5 years from now? Or, you know what, I'm okay. This will become a corporate entity. 5 years from now, it may not really reflect what it was, but this is the best I can do right now. Is it even an option? Are there willing and able associates out there? Obviously, it depends on your geographic location. It depends on what's happened historically. In some cases, it depends on how close or far away you are from a vet school. There's so many things that go into play, but are associates even an option? Are they out there looking to buy? In general terms, there are not enough buyers right now, associates looking to make that leap. Don't forget about local, either friendly or not so friendly competitors. You know, it doesn't matter what relationship you've had in the past. Maybe now that it's time to move on, maybe they're looking to expand their footprint. And as long as they give you fair market value, who cares? Let's go ahead and knock on that door and see if that's an option. What's your timeline? What are your goals? What's your financial outlook? Are you, if you sell to a corporate private equity buyer, guess what? To maximize the return, they want you to work in that practice for an indefinite period of time. Okay. Are you willing to do that? Or do you want to be done? If you want to be done, you're going to have to give up some of the purchase price. If you're willing to work, it'll be more, because guess what? They'll turn around and they will make the profits while you're the associate, right? Conversely, hey, I want to keep this a locally owned practice, so I'm willing to maybe take on less than a private equity or corporate group would give me in order to facilitate and potentially on the back end, mentor, prop up this associate or associates that are going to buy my practice. It's worth it to me. A lot to think about, okay? All right, so maybe you've chosen, or maybe you know what, I'm going to entertain both options. So how do we get the word out? Okay, again, not an exhaustive list, what we see most commonly. We'll touch on these. So to broker or not to broker, honestly, I think you try not to. I mean, we'd all like to sell our house without a realtor, right? Save the commission. So brokers are going to take a large chunk of that sale. Okay, so I would say only use a broker if you need to. In this market, for the most part, you shouldn't need one, but if you do, you know your situation, go ahead. If you do, like anything else, get references. Talk to a veterinarian who sold their practice with that broker. What was the experience like? And obviously make sure you know exactly what the financial terms are. Talk to your trusted advisors. We all have our people. So present your situation to them, get their thoughts. What are my best options? Talk to your vendors. They've got their ears in the ground. They're talking to all these practices. They know what's going on. They know who's buying, who's selling. The WVMA is a great resource. Most of you've already connected with that. Connect with them, connect with your other social networks. I mentioned local competitors. Don't discount them if they're looking to expand their footprint in your community. More and more, the vet schools are really providing networks out there, okay, for their alumni looking to get back into a certain community, a certain type of practice. So connect with vet schools to see if you can get a pipeline there. No matter who you're talking to, try to control the narrative, right? Rumors can start. You want to control it for as long as you can. So do your best to protect your practice on a need to know basis, especially your staff. You want to keep them, you know, on a need to know basis. Financing, have the banker ready. You might need them on either side of the transaction. And here's the second or third time I'm saying it, due diligence. Be ready, because as soon as you start entertaining offers, they're going to want to see your information. Have it on a flash drive, have it ready to disseminate to multiple people. Okay, we get to my favorite part of the presentation. Okay, last but not least, you're ready to make an offer or entertain offers. It's called a letter of intent, or on a private sale, maybe a term sheet that you pre-negotiate. Long and the short of it is, this is not necessarily a legal document. This is just getting all of the specifics on paper that we agreed to. All right. And we will do a much deeper dive into this in our last series in January. But it's going to tell you the price, the valuation. Okay. And that's going to be structured between cash, maybe an equity percentage in the corporation that's buying you, and maybe based on incentives that occur in the future. It's going to very clearly tell you how the payment terms work, what cash is received at closing versus what is deferred. It's going to tell you what's included and not included in that sale. Very important. Make sure that's what you expect. Beware the contingencies. In short, EBITDA, earnings before interest, taxes, depreciation, amortization. They may base some of what you get in the future based on EBITDA thresholds. Once you're not the owner, can you really control that? Same thing with revenue. What's going to happen in the future? None of us know what's going to happen tomorrow. Can you really control that? Do you really want to set some of your return based on what's going to happen in the future? Same thing with equity. Okay, you're investing. It's like buying stock. You're investing in a company that could be worth zero someday. I'm not saying it's going to be, but all those contingencies, you always have to think these could be worth zero. These are my wild card. All I really have is my cash at closing. Okay, it's going to have your employment agreement and the terms. If you expect to do that, it's going to tell you in generalities what's going to happen with that real estate. This is non-binding. Okay, but what it means is once you sign a letter of intent with somebody, you will only negotiate with them for that period of time, but either party can walk away. Okay, like the broker, ask the company for references. Who have you sold to? I want to talk to them. Talk to the veterinarian who sold. What happened before? What happened during? What happened after? Obviously, the farther out you can get from a sale, the better, because they can tell you, is there anything you regret? And third time, be ready for due diligence as part of the letter of intent process. Okay, so very simply put, what do you do now? Before the fourth part of our series, evaluate your options. You're all in a different position. So what's making the most sense to you? Talk to your team of experts or your trusted advisor or advisors. Figure out what your ideal timeline is now compared to what it may have been going into this process. Maybe you're ready to start entertaining offers or to make an offer. Maybe there's some adjustments you have to make to your situation. And one final time, get ready for due diligence. All right, let's end with a poll question. Based on everything you just heard, are you ready to entertain offers or make an offer? You got some adjustments to make. I'm still considering my ideal timeline and options, or quite frankly, these can happen all at the same time. Is it all the above? All right, here we go. All right, so, okay, nobody today is ready to entertain offers or make an offer. Half of you have some adjustments to make. Third of you have all the above, and then the rest of you are still considering what your ideal timeline is. So thank you all. Lee, if you could wrap us up, I'd appreciate it.
Sure, absolutely. Well, we did what we said we were going to do. We didn't have enough time for questions. I want to be respectful of everybody's time. We did have a couple come in, but we can reach out to you directly with some answers to those. You know, in all the time you took, I thought you would have mentioned due diligence once, but I guess maybe not. No, that was great. You guys, Joel and Andy, that was fantastic. Really good. So I am going to wrap it up here, but I just want to mention that you can go to sva.com/vetseries to sign up for the last webinar in the series. You can also find news and information that may affect your practice. Now, that final one of the buy-sell series, which is part 4, is January 12th, and the topic is understanding the sales process. So lastly, I just want to remind you all that the SVA team is only a phone call or an email away. So if you're a client, reach out to your SVA professional as questions arise. And if you're not currently an SVA client, you can contact me or anyone in our business development group so we can get you the help or the answers that you need. Thanks again for being with us today, and happy holidays. Bye-bye.